Hi everyone, my name is Katie, and today we're going to be talking about the market efficiency anomaly sell in May and go away. So we're going to be looking at some slides and then some graphs. So let's get started. So like I was saying, I'm going to be talking about the market efficiency anomaly sell in May and go away. Looking at an overview of the presentation, first we're going to talk about the efficient market hypothesis and CAPM. Then we're going to discuss what the Halloween effect, which is another name for the anomaly, actually is. Then we're going to talk about the research by Dichtel and Drobitz, my methodology to repeat this research, the graphs of the data, the overall findings, and the conclusion. The efficient market hypothesis. According to our textbook, this is one of the cornerstones of modern finance theory. It is a market in which stock prices are close to their intrinsic values. This means that people cannot beat the market for extended periods of time. The market will eventually even out any abnormal returns. There are three types of market efficiency: weak form, strong form, and semi strong form. The type that we are most concerned with today is the semi strong form. It states that all publicly known information is immediately factored into a stock's price. Capital asset pricing model helps investors figure out what returns they should expect. Investors are no longer able to beat the market once the abnormal return is published in a well-known journal. This all factors into the anomaly I'm discussing, as well as my methodology. So what it actually is the Halloween effect? The Halloween effect says that investors should hold their stocks from November through April and sell them in May for cash. The idea behind it is that stock markets are relatively quiet during the summer months due to bankers going on vacation. So you wouldn't really be missing anything during the summer if you weren't invested. The research by Dichtel and Drobitz is titled Sell in May and Go Away, Still Good Advice for Investors? One thing this study did differently than previous was that they factored in the year in which the anomaly was first published in a popular journal, which was 2002. Out of the many shortcomings they pointed out, this one was a major one. This goes back to the whole semi-strong form market. If markets are truly efficient, people would stop gaining from the anomaly as soon as it became publicly known information. They do the same type of research that I conducted, but on a much, much larger scale. They look at indices all over the world, while I'll just be looking at 3 in the US. In order to repeat the research, I planned to examine the biannual returns of the Dow Jones Index, the S&P 500, and Russell indices, and compare the May through October with the November through April returns. So like I just said, my methodology was to calculate the returns for May through October and November through April for 6 years, which include 1 year prior to 2002 itself, because that's when the information became publicly available and people should have not been able to gain abnormal returns at this point. The 2008 financial crisis, and then 3 other random years to keep the data non-biased and compare these biannual returns. So moving on to the graphs themselves, starting with the indices and how they measure up together over time. Graph depicts the 3 indices stacked together over time. As you can see here, all 3 indices coincide for the most part throughout the years of the duration of the experiment, and therefore can be a trusted source. Moving on to the actual results of the research. So here we have the Dow Jones Index. In each year, returns in November through April were either higher or less negative than those in May through October, as you can see from the graph. And the blue is depicted by May through October, and November through April is shown by the purplish red color. And again, for the S&P 500, they are similar, but a few differences. The dividends were assumed to be reinvested back into the fund itself and were accounted for in the adjusted closing price of each index. 2002, 2008, and 2012 show huge discrepancies in the biannual returns. 2005 is relatively large, but not quite as big. But 1996 and 2015 almost don't show a difference at all. Again, my research was just a small sample among a massive population of data. In conclusion, personally, I'm not convinced. While my data does suggest that the anomaly exists, it is such a small subset of the population that it's hard to make a firm answer. In my opinion, markets are efficient. Many other factors come into play when determining stock market returns, and so many other explanations can be given for a particular period of time. Many large-scale research studies have been conducted attempting to prove one way or another. In some years, the Halloween effect has definitely been present, but in most years, it's too difficult to say. And that's all I have for today. Thank you so much for listening.